What if I told you that the most powerful institutions in the modern world, the ones that influence the price of your groceries, your rent, your job prospects, and your future, operate in a way that is almost entirely invisible to you? What if the greatest political drama of the last century didn't take place in parliaments or presidential elections, but inside closed-door meetings, private banking committees, and quiet boardrooms where the real levers of global power were being installed, one subtle mechanism at a time? And what if the entire system we rely on, our currencies, our savings, our national debts, rests on ideas so counterintuitive, so insulated from public understanding, that most people don't even know the questions they should be asking? Today, we're going to peel back a curtain that very few people ever look behind. Because the story of how central banks quietly took over the world isn't a conspiracy theory, it has a timeline. A series of choices. Cause and effect events that led to an unprecedented transfer of influence from democratic governments to technocratic financial institutions. And the real mystery, the one we will return to again and again throughout this video, is this: did central banks rise to power to save nations or to control them? Let's begin. A system built from crisis. Most people assume central banks have always existed, that they are simply part of the natural structure of modern economies. But the truth is far stranger. Central banks were born out of fear of instability, fear of war, fear of governments going bankrupt, fear of people losing trust in money itself. The earliest example usually cited is the Bank of England, formed in 1694, but it wasn't built to manage inflation or stabilize prices. No, it was created for one reason. The British government was broke. Reeling from expensive wars with France, England needed money, fast. Private lenders were hesitant. So Parliament approved a new institution, a bank that could raise funds from wealthy investors. In exchange for extraordinary privileges, this bank would lend money to the government. The government would give it the right to issue banknotes, effectively early paper money. And with that simple exchange, debt for power, the first prototype of the modern central bank was born. But here's the twist. It wasn't the last time this would happen. In fact, the pattern would repeat again and again over the next 300 years. A government faces crisis, gives it turns to private bankers or central authorities, gives those authorities gain more control over the monetary system. From Napoleon to the American Civil War, from European empires to rising industrial nations, financial instability was always the opening through which central banks expanded. But the true rise, the moment the modern system locked into place, didn't happen until the early 20th century. And it started in a luxurious private retreat. During a secret meeting, when money became a machine. Imagine this. The year is 1910. A small group of bankers and politicians slip quietly onto a private train in New Jersey. They use first names only, they avoid reporters. Their destination is Jekyll Island, a private resort owned by some of the wealthiest families in America. For a week they debate, draft, and refine a plan that would fundamentally reshape the U.S. economy. That plan would become the Federal Reserve System. Now it's important to pause here and avoid sensationalism. This was not a cartoonish conspiracy. It was a response, once again, to crisis. The panic of 1907 had shaken the U.S. to its core. Without a central authority capable of providing emergency liquidity, banks had failed, the public panicked, and trust in the financial system collapsed. So like England before it, the United States created a central bank to stabilize the economy. But here's the key point. The Federal Reserve didn't just stabilize the system. It re-engineered it. It introduced a lender of last resort, capable of injecting money into the system during panic. A centralized authority to manage interest rates. A mechanism to influence credit, borrowing, and ultimately, economic growth. Money was no longer a simple medium of exchange backed by gold or silver. It had become a policy tool, a lever, an instrument. And as the 20th century progressed, those levers became more powerful. The Great Depression, World War II, the collapse of the gold standard in 1971, the inflation crisis of the 1970s, the rise of globalization in the 1990s. Each event moved central banks from the background to the driver's seat. But with great power comes great temptation and pressure. Because once a central bank discovers it can prevent recessions or delay them, the story shifts from stability to control. When the system became too big to fail by the early 2000s, Central banks had become the guardians of global financial stability. Their tools, interest rates, reserve requirements, asset purchases had grown more complex. Their influence had spread across borders. And then came 2008. The global financial system imploded. Millions lost their homes. Banks collapsed. Trillions of dollars evaporated. And for the first time in history, central banks around the world coordinated their actions. They slashed interest rates to zero. They launched quantitative easing, buying massive amounts of government debt and financial assets to inject liquidity into the economy. They bailed out banks that had taken reckless risks. They stepped in not just as lenders of last resort, but as lifelines. Without central banks, the global financial system would have collapsed. But here's where the story twists. When you save a system from collapse, you also become responsible for what happens next. And what happened next was unprecedented. By 2010, central banks were holding trillions in assets. By 2015, interest rates in some countries went negative. By 2020, the Federal Reserve alone was pumping trillions into financial markets. The system had become addicted, dependent on constant support. Governments ran record deficits, assuming central banks would buy their debt. Corporations borrowed cheap money to buy back their own stock. Investors took on more risk, confident the central banks would step in if things went bad. The phrase "too big to fail" didn't just apply to banks anymore, it applied to the entire global economy. And that dependency created an invisible shift in power. Because the more you rely on an institution, the more control it has over you. Power without oversight. Over the last decade, central banks have become some of the most influential institutions in the world, surpassing many governments in their ability to shape economic outcomes. But here's the paradox. They are unelected. They operate with limited public understanding. They rarely face meaningful oversight. And their policies, while often well-intentioned, come with side effects that ripple through every part of society. Side effect 1. Asset inflation. When central banks push interest rates to zero, borrowing becomes cheap. That sounds good. Until you realize what happens next. People don't borrow to build businesses. They borrow to buy assets. Stocks rise. Real estate prices explode. Wealth inequality widens. Because those who already own assets benefit far more than those living paycheck to paycheck. Side effect 2. Zombie companies. Cheap money keeps weak companies alive. They can't grow. They can't innovate. But they can borrow. These zombie companies clog the arteries of the economy, preventing resources from flowing to productive businesses. Side effect 3. Government addiction. When interest rates are low, governments can borrow endlessly. This removes the political pressure to balance budgets or make tough decisions. It creates a cycle where politicians promise more, spend more, and rely on the central bank to make it possible. Side effect 4. Currency erosion. When money supply grows faster than economic growth, purchasing power falls. Inflation becomes a hidden tax. And ordinary people, not governments, not corporations, pay the price. All of these side effects compound. And they lead us to where we are now, a world where central banks exert enormous influence, yet very few understand how they operate or what the long-term consequences may be. But to fully appreciate where this story is heading, we need to connect it to something bigger, something happening right now, because the patterns we've seen before are repeating. The 2020 shock and the new playbook, the pandemic of 2020 didn't just test global health systems. It became the greatest economic shock since World War II, and once again, central banks stepped in. Only this time, they didn't just stabilize markets. They transformed them. Interest rates dropped to zero worldwide. The Federal Reserve printed more money in a single year than in the previous century of its existence. Governments spent trillions, financed almost entirely by central bank purchases. In some countries, central banks even bought corporate bonds and ETFs. This blurred the line between market and state in ways previously unthinkable. And the result? Exactly what the cause and effect history predicted. Asset prices hit record highs. Housing became unaffordable for entire generations. Inflation surged to levels not seen in 40 years. Government debt soared past GDP in multiple nations. But perhaps the most important development was the one that slipped under the radar. Central banks began exploring and, in some cases, launching central bank digital currencies, CBDCs, digital money issued directly by the central bank. This isn't crypto. It's programmable, trackable, government-controlled currency. And it represents the biggest leap in central bank power in modern history. Suddenly, monetary policy could become automatic. Negative interest rates applied to your personal account. Stimulus delivered directly to citizens. Spending categorized and monitored. Transactions restricted in real time. A level of control that previous central bankers could only dream of. The same institutions that once had limited influence over paper money could soon influence every digital dollar. And this brings our story full circle. Because the same forces that created central banks, crisis, fear, instability, are now driving them toward even greater authority, but this time the power is global. And the consequences are far-reaching. The cycle we never notice at this point. The pattern should be clear. The rise of central bank power is not a single event, but a cycle. A crisis hits. Governments panic. Central banks intervene. Their influence expands. The economy becomes dependent on them. A new crisis emerges, often caused by that dependency. The cycle repeats with even greater central bank control. This is the hidden story of modern finance, not corruption, not masterminds, not conspiracies. Just incentives. Actions taken in moments of chaos that accumulate into power structures no one planned but everyone now relies on. And with each iteration, from 1694 to 1913 to 1971 to 2008 to 2020, the scale grows, the stakes rise, and the consequences become harder to reverse. So the real question now is, where does this path lead next? 3 takeaways you need to understand. After 3 centuries of crisis, intervention, and expansion, 3 lessons emerge. Takeaway 1. Power centralizes quietly. Central banks did not seize power. They accumulated it, piece by piece, because governments needed them. But power gained through dependency is still power. And once an institution becomes indispensable, removing or reforming it becomes almost impossible. Takeaway 2. Monetary tools shape society. Interest rates are not just numbers. Money printing is not just policy. These decisions determine who can afford a home, which companies survive, how much your savings are worth, whether your retirement is secure. Central banks may be technical institutions, but their impact is profoundly human. Takeaway 3. The next phase will be digital. Central bank digital currencies represent the biggest shift in money since the invention of the banknote. They offer efficiency, stability, and control. But they also introduce the possibility of unprecedented surveillance and influence. And once adopted, they will be extremely difficult to roll back. Or, open question, so we return to the mystery from the beginning of this story. Did central banks rise to power to save nations? Or to control them? History suggests the answer may be both. Because every time they were called upon, they delivered stability, but at a cost. And today, as inflation rises, governments rely on debt, and digital money looms on the horizon. We are approaching another turning point. One that will shape the next century. The real question is not whether central banks will act. They will. The question is whether we, the public, will understand enough to question how. If you want to go deeper into the hidden mechanics of money, the future of digital currencies, and the systems shaping your financial life, make sure to like, subscribe, and leave a comment with the topics you want us to unravel next. Because the more we understand how the world really works, the less quietly its power structures can operate. And this story is far from over.